capital gains tax. It's a phrase that can send shivers down any investor's spine. But fear not. In this video, we'll explore effective strategies to minimize your capital gains tax burden in 2025. Hello, everyone. I'm Anna, and I'm here to guide you through the maze of capital gains taxes. We'll cover everything from tax loss harvesting to utilizing retirement accounts effectively, Anna said in a friendly tone. First, let's understand the basics. Capital gains are profits you make from selling assets, such as stocks, bonds, or real estate. These gains are taxed differently depending on how long you've held the asset. Anna explained that if you hold an asset for more than a year, any profit is considered a long-term capital gain, which is generally taxed at a lower rate than short-term gains. She added that short-term gains from assets held for a year or less are taxed as ordinary income. Ever sold an asset for more than you bought it for? Congratulations, you've realized a capital gain. But Uncle Sam wants his cut. That's where capital gains tax comes in. Capital gains are generally classified as short-term for assets held a year or less, or long-term for assets held longer than a year. Short-term gains are taxed at your ordinary income tax rate. Long-term gains enjoy preferential rates, usually 0%, 15%, or 20%, depending on your income. Stocks, bonds, real estate, cryptocurrency, many types of assets can trigger capital gains tax when sold at a profit. Understanding capital gains tax is key to smart investing and tax planning. Remember, tax laws can be complex, so consult a professional for personalized advice. Ever wonder why the USA charges capital gains tax? It all goes back to funding the government. Taxes, including capital gains, pay for vital services and public projects. Capital gains tax is levied on the profit you make from selling an asset, like stocks or property. The rate depends on how long you held the asset. Shorter holding periods usually mean higher rates, while longer-term investments often get a more favorable tax treatment. So, while it might sting a bit, capital gains tax contributes to a functioning society. It's the price we pay for progress and stability. Now you know. In the world of investing, understanding capital gains is crucial. But did you know there are different types? First, let's talk about short-term capital gains. This applies when you sell an asset you've held for 1 year or less. I sold those shares after only 9 months. What does that mean for my taxes? Anna said, worried. Anna is about to learn about short-term capital gains. Short-term gains are taxed at your ordinary income tax rate. This could be higher than the rate for long-term gains. Now, let's move on to long-term capital gains. These apply to assets held for more than 1 year before selling. I've held on to these stocks for over a decade. Time to diversify, Mark said, contentedly. Mark is about to realize the benefits of long-term gains. Long-term capital gains are generally taxed at lower rates than short-term gains. Depending on your income, this could be 0%, 15%, or 20%. Hey, Ben, guess what? I finally sold those shares I bought a few years ago, Anna said excitedly. Nice. Made a good profit, I hope? Ben asked inquisitively. Definitely, but now I'm trying to figure out this whole capital gains tax thing. It's confusing, Anna replied, concerned. Anna has just triggered a capital gains event by selling her shares for more than she bought them. But what exactly does that mean for her taxes? Okay, so I bought the shares for $5,000 and I sold them for $8,000. Does that mean I owe tax on the entire $8,000? Anna asked, sounding confused. Not quite. Capital gains tax is only applied to the profit, which is the difference between the selling price and the purchase price. Think of it this way. You subtract your initial investment from what you sold it for. $8,000 minus $5,000 leaves you with a $3,000 profit. That's your capital gain, Ben explained. Helpfully, okay. Understanding how the IRS tracks capital gains can seem daunting, but it's crucial for accurate tax reporting. Capital gains are profits you make from selling assets like stocks, bonds, real estate, or even collectibles. I sold some stock last year. Now I have to figure out the cost basis, Anna said, annoyed. The IRS needs to know your cost basis, what you originally paid for the asset, plus any improvements or expenses. They subtract your cost basis from the selling price to calculate your capital gain or loss. Brokerage firms are required to report your sales to the IRS on Form 1099-B. This form includes details like the date of sale, proceeds, and cost basis. The IRS matches this information against what you report on your tax return. Okay, then NIB matches my records. That makes things easier, Anna said, relieved. It's important to keep accurate records of your purchases and welcome to Money Matters. Today, we're diving into a topic that often raises eyebrows: how the ultra-rich legally pay zero in capital gains tax, Anna explained informatively. The average person pays capital gains tax when they sell an asset for more than they bought it. But the wealthy have strategies to avoid this. Sarah, the key is long-term planning. One effective method is to use a donor-advised fund, Mr. Sterling explained professionally. A donor-advised fund? How does that work? Sarah asked, curious. You donate appreciated assets like stocks to the fund. You get an immediate tax deduction, and the fund sells the assets tax-free, Mr. Sterling replied, explaining. Mr. Sterling further explained that Sarah can then recommend grants from the fund to charities over time, fulfilling her philanthropic goals while avoiding capital gains taxes. Another strategy involves borrowing against. Anna is worried about the capital gains taxes she'll face when selling her investment property. I don't know what to do, Ben. I'm going to lose so much money in taxes when I sell this property, Anna said, worried. Have you considered a 1031 exchange, Anna? Ben asked calmly. A 1031 exchange, named after Section 1031 of the IRS Code, allows you to defer paying capital gains taxes when you sell an investment property and reinvest the proceeds into a similar property. Defer? So I wouldn't have to pay the taxes right away? Anna asked, hopeful. Exactly. You reinvest the proceeds from the sale into a like-kind property, and you defer the capital gains taxes. You essentially roll your investment into a new property, Ben explained informatively. Ben explains the basic concept to Anna. The key is to reinvest in a like-kind property. This doesn't mean it has to be the exact same. Anna wants to buy a house, but doesn't want to sell any of her stock holdings to pay for it because she doesn't want to pay capital gains taxes. Mark, I really want to buy a house, but I'm worried about the capital gains taxes if I sell my stock portfolio, Anna said, concerned. That's a valid concern, Anna. Selling appreciated assets can trigger significant tax liabilities, Mark replied, calmly. Mark suggests an alternative strategy. Instead of selling, consider borrowing against your portfolio, Mark suggested informatively. Borrowing? How does that work? Anna asked, curious. Mark explained, you essentially use your stock holdings as collateral for a loan. You get the cash you need without triggering a taxable event. The narrator then explains what a taxable event is. A taxable event is when you sell an asset for more than you bought it for. Here's how it works. Your stocks have appreciated. Today, we're going to unravel a financial strategy that can significantly impact generational wealth, the step up in basis. Professor Armstrong asked, who can tell me what cost basis means? A student replied, isn't it the original price you paid for an asset? Professor Armstrong answered, correct. Cost basis is exactly that. Now imagine you bought stock for $10 and it's now worth $100. The cost basis is $10. If you sold the stock, you'd have to pay capital gains taxes on the $90 profit. Professor Armstrong asked inquisitively, but what happens when you pass that asset on to your heirs? Let's fast forward. Sarah inherited that stock from her father. It was worth $100 at the time of his death. Mr. Henderson reassured Anna, because of the step-up basis, your cost basis in these stocks is now $100. If you sell them for $100, you owe no capital gains tax. Anna asked, Opportunity zones, or OZs, offer a unique way to defer and potentially eliminate capital gains taxes. Anna is about to explain how this works. Let's say you sell stock and realize a capital gain. Ordinarily, you'd owe taxes on that gain right away. But if you invest that gain into a qualified opportunity fund, or QOF, within 180 days, Anna explained. Anna clicks to the next slide. It shows a flowchart. Capital gain, investment in QOF, tax deferral. You can defer paying those taxes until the earlier of when you sell your QOF investment, or December 31st, 2026, Anna continued. Anna continues to explain the benefits of investing in opportunity zones. Now, here's where it gets even better. If you hold your QOF investment for at least 5 years, you get a 10% step up in basis. And if you hold it for at least 7 years, you get a 15% step up. Anna said enthusiastically. Opportunity zones, or OZs, offer a unique way to defer and potentially eliminate capital gains taxes. Anna is about to explain how this works. Let's say you sell stock and realize a capital gain. Ordinarily, you'd owe taxes on that gain right away. But if you invest that gain into a qualified opportunity fund, or QOF, within 180 days, Anna explained. Anna clicks to the next slide. It shows a flowchart. Capital gain, investment in QOF, tax deferral. You can defer paying those taxes until the earlier of when you sell your QOF investment, or December 31st, 2026, Anna continued. Anna continues to explain the benefits of investing in opportunity zones. Now, here's where it gets even better. If you hold your QOF investment for at least 5 years, you get a 10% step up in basis. And if you hold it for at least 7 years, you get a 15% step up, Anna said enthusiastically. I just don't get it, Mark. I work so hard, but I always seem to be struggling. How do wealthy people do it? Anna said, frustrated. It's not just about how hard you work, Anna. It's about working smart and adopting the right financial habits, Mark replied calmly. Mark begins to explain the key financial habits that separate the wealthy from the average person. First, they prioritize budgeting and tracking expenses meticulously. They know where every dollar goes. Next, they invest early and often, diversifying their portfolio to manage risk. They understand the power of compound interest. Financial literacy is key. They continuously educate themselves about personal finance, investment strategies, and market trends. They are savvy negotiators, always seeking the best deals and rates on loans, insurance, and other financial products. Okay, no more impulse buys. I'm sticking to